Welcome back to the CRE Spotlight. I have my good friend Elijah Brown, occasional dinner partner, oftentimes partner in crime and in dissent against the government, and just various forms of tomfoolery. But he's also an extremely successful and articulate real estate investor. So we're going to kick this off and let Elijah tell us a little more about himself.
Yeah, now we're cooking in the kitchen. So from dinner to preparing a meal, I love it. Andrew, thank you so much for having me on. And I also wanted to thank you for all the interaction in the last few weeks. This whole LinkedIn thing and reaching out to new investors has been a relatively new process for me. And you've been instrumental in helping me make relationships and commenting on my posts. So I wanted to thank you first of all for that. It means a lot, and yeah, I know we're going to have a really good relationship moving forward, just because of the support that you've already shown me. So thank you for that.
That's so kind of you, Elijah.
Sure. So let me give you a little overview of my business and what I do. So I've been syndicating real estate deals, specifically multifamily, for about 7 years now. I started off originally with single family, just doing buy and hold rentals with friends and family. And then I was able to scale that while I was working my W-2 job. And so nights and weekends, I was putting together larger and larger deals and raising capital on the side, nights and weekends, working very, very hard. And I was able to amass a significant number of units to where I was able to leave that job and then focus on it full time. And that's where I am now. My company is called Gold Hawk Capital, and we focus on value add apartment buildings in the 100+ unit range in Phoenix, Arizona.
That's a great market, Elijah. Why don't you shed a little more light about your background? Because you're not just some guy that's a real estate investor. Your level of sophistication when it comes to technology and specifically underwriting is a little more than the average syndicator. So why don't you give us a little glimpse into how did you become such a great underwriter? And then why don't you do it? We'll cut right into shameless plugs. Heck, it's our show anyways. I understand you're going to be doing a free educational series about underwriting.
Oh, I floated that as an idea, and
I'm holding you to it now. You can't just put it out.
I think I should do it. Yeah, no, I appreciate that. So I actually got my start in commercial real estate while working for a company. So I was working at one of the largest REITs, and I started off in asset management, doing a lot of underwriting of properties that we already owned. So stuff like redevelopments and dispositions, and then trades with other JV partners and stuff like that. So I got a really good basic understanding of how to analyze cash flows and understand the various inputs and outputs for real estate transactions. And I think the most valuable thing that they taught me was when my boss came and took my mouse away for a month, and he said, "You're going to go learn how to use your computer without a mouse. You're gonna have to learn all the keys." And that made me like 10 times faster at Excel. I had to know all of like the alt commands and the hotkeys and the formulas, and I got really good at just putting together cash flow models. And so that's where I learned how to do my modeling. And then, as I said, on nights and weekends, I was putting together my own deals for my own investors. And so I got relatively good at applying that modeling skill set that I had at the corporate job to apartment buildings. And, since then I've built my own models, and I actually have, a free download on my website that you guys can check out. It's in my featured section on LinkedIn. So yeah, that's I learned by working for a real estate company.
That's awesome. That's really great. So Elijah, explain to us, what is the hierarchy of capital raising? How does it go from when you first start off to hopefully the end game of the Elijah Brown method?
Yeah, it's a good question. So, and I would highly recommend the book "Raising Private Capital" by Matt Faircloth. That was a book that kind of blew my mind, and I actually, reached out to Matt and had a conversation with him about it. And it starts with just people around you. So the folks that you already know, friends and family, people who are going to believe you and trust you when you don't have a track record and you've never done it before. I feel like in the very beginning, it's very difficult to go out and ask a new person or a random person to trust you and believe in you when you really have nothing to show for it. And so, the approach that works for most people is to start by reaching out to everyone they possibly know, friends and family, and raising as much capital as they can from that group so that they can build a track record. The next step from there is that you want to focus on expanding that group of friends and family. So you've got the close group that have maybe invested in a few deals. Now you want to reach out to coworkers, people who are friends of friends, the word of mouth type of investors. And so, I started off on my first deal with just my cousin and my best friend. It was just us three, and we did two of those single family houses. And then on the next deal, I brought in two of my coworkers. So, I started reaching out to I casted a wider net to try to gain interest, because at that point it's like no one in my immediate family or my small friend group was very interested or had $50,000 to spare. So I started casting my net a little wider, and then eventually got into group number three, which is small investors. So these would be like, I guess, low to medium, high net worth, typically unaccredited. And, you'd bring them in as either a JV partner or through the 506B, exemption from Regulation D, which allows up to 35 non-accredited investors. And so those investors typically would come from a word of mouth, or if you have some type of social media presence, you can find them there. And once you're at this level, you probably have somewhat of a track record. You've done two or three, maybe four or five deals. Perhaps one of them has gone full cycle. And now you can start making the case to high net worth individuals, which I would call group number four. So these are people who are typically accredited. So they've got either, over $1 million in net worth, or they've been making a couple $100,000 or 300 or more if they're married for the past couple of years, and they have the expectation of doing that in the future. We call these accredited investors. They have done it before, they've invested in stuff, and they understand the risks involved in these types of deals. And with these types of investors, there's a higher level of sophistication. They're not just going to go place their money with a, first time, buying a single family house to flip it. They want to get a return on their money, and they know that 90% of the battle is trusting the sponsor or the person who's putting the deal together. So that's group number four. And for a bunch of my Arizona deals, I've worked with high net worth investors on those deals. I even had a family office actually come in on one of those deals. But then once you're there and you've tapped out your friends, family, and smaller investors, word of mouth types of investors, you really need to start thinking about scaling. And to be able to go from, 500 or 1,000 units to 100,000 units with like $1 billion under management, you really need to you need to get larger checks. You need people who can write $5 to $50 to $100 million checks in one go, and you get that money from family offices. So family offices is group number five, and you really need a solid track record to be able to go after family office money. I'm talking like 5 to 10, maybe even 15 years worth of, full cycle deals with strong returns. You should be focused in a specific niche, because these offices, they don't want you to do the diversification for them. They want to invest in your deal because it's giving them exposure to a certain asset class in a certain market. For example, what we do is value add multifamily in Phoenix, Arizona. And so the family office will, will evaluate that opportunity and then say, okay, we desire exposure in that market, in that asset class. Let's invest. And so that money, it comes with some strings. So the larger the checks, the more strings that are attached. They're going to negotiate fees, so you're going to get paid a little bit less on your fees and on the back end with the promote. And they're also going to have more oversight. So you may not have as much control with the decision making. They may have some voting rights on specific things because they're writing a large check and they want to see a return of that capital. And so it definitely comes with more strings. Some syndicators and sponsors are actually against raising this type of money because they don't want to deal with the strings. And my personal opinion has always been, I don't care if the fees are beat down to such a low level if I can go after massive deals, because at the end, I can have a smaller portion of the deal that's going to make me $100 million or a much larger portion of the deal that's only going to make me $20 million. And I'd way rather go after the big stuff for the potential of making way more. So family office, that's level number 5. And then, once you're there and you've got, $1 billion portfolio and thousands of doors, you can start thinking about, how do you want to leave your legacy? Do you want to be a very large company and be making $100 million a year? And if you want to be doing that, you need to be going after institutional investors, like pension funds and large companies that invest in this stuff, retirement accounts, all kinds of different large, like billion, trillion-dollar institutions that are looking for strategies. And this comes with, you have to have a significant track record and experience and, know what you're talking about and have very good deals and a lot of deal flow. And, this is going to come with a lot more strings. So they're going to beat down your fees more. They're going to expect a lot more. They're going to be very active in managing you and what you're doing in your decision-making process. And that's part of the game. If you want to really accept, if you want to accept $100 million checks, you are then beholden to those people. If you don't want to, then invest your own money. And if you don't have it, then you're going to have to look for investors. So that's level number 6, institutional, which 99.99% of sponsors never go to that level. So.
All right. That's a great explanation for anybody curious about the stages and levels of capital raising. So what is the stage you're currently at, Elijah?
So I'm at stage number 4, which is high net worth investors. And this is what I would call, what you would call retail. So, going out on LinkedIn and publishing content with the goal of, attracting people who are accredited. So they're sophisticated and they've got net worth and income, and they're looking to now increase their passive income and their generational wealth by investing in opportunities that I have to offer. I'm also at the same time planting seeds for family office deals later down the line. Family office relationships take months and years to establish. I heard from one guy that it takes an average or maybe a minimum of 5 handshakes with one office for them to write you one check. So you're going to have, meetings 5 times at least. And they're not going to happen every single week. You're going to be having a couple meetings a year. They're going to be evaluating your strategy, watching your deals go full cycle, and then making a decision like, okay, I trust this guy enough to give him, to give him a test investment of, $1 or $2 million and see what happens. So that is something you want to start now. You don't want to wait to do that. So that's my next, 1 year. That's my 1 year out.
All right, that's wonderful. So would you be looking to do more 506c in the near future?
I think so. It depends. So I think it really depends. I'd like to grow my presence on social media, so that, specifically LinkedIn, so that it makes sense for me to do, public solicitation. But right now, my investor base, it wouldn't really make sense for me to go posting on Instagram and LinkedIn with a deal, because I don't think I'm going to attract that many people. So historically, I've only done 506B and JV deals, and 1031 of other deals as well within a JV structure. But I'm not opposed to doing 506C. I think, if I have a promotion channel and funnel that is large enough, it would make sense for us to do some public advertising. Yeah.
We're gonna just keep harassing you then, Elijah, to really up your game on the social media.
Yeah.
You really write some wonderful long form articles, which is
Thank
really
you.
refreshing, because I know one of your pet peeve is fluff content. You really like the long form, heavy with facts and figures, and real analysis, not recycling a Warren Buffett quote doesn't really do it for you. Correct?
I really appreciate the stuff that you've been posting, because I think you actually put in a little bit of thought. When we had dinner and you were like, yeah, like I can pump this stuff out, and I was like, oh boy, it's gonna be like just like a random fact every day. But your stuff tends to make me laugh. I think you use a lot of humor in the stuff you post with the funny images and stuff, and I think that's a very good strategy. I like it a lot, and it's one of the more interesting contents that I see. But yeah, like you said, a lot of people are just pumping out garbage, and it's annoying. So I think the motto should be like, add tremendous value, and then you'll get investors. That's
Have you
just
thought about starting your own podcast?
No, I think it's too saturated. I think there are so many people out there doing it that I think I should first go and appear on everyone else's podcast, focus on my article writing. I'm putting out an article every Friday. And then, that's probably enough for now. I'm stretched pretty thin. I'll be looking probably to add a few, either employees or contractors to my team within the next 6 months or so. But I don't think I'll be doing a podcast anytime soon.
All right. Well, we're going to encourage you to appear on more podcasts. I've appeared on several, and you're actually more academically trained for it, and professionally trained for it. So I will harass some of the people that I've appeared on and say, oh, by the way, Elijah would make an even better guest. So I will get around to doing that, Elijah.
Appreciate
So
that.
expect to see your inbox flooded with.
Take everything I say with a grain of salt.
Overbearing Andrew emails. Dear so-and-so, Elijah's very awesome. You should have him on your show. You will see those soon. A good portion of our audience are LP investors. So they're not, these are people with owning a small business or white collar job. And they really they want to just buy a syndication, and they don't want to have a lot of headache. The thing that scares them when I talk to them, the thing that scares is the due diligence. What is the advice that you would give to an LP investors to help them streamline and make their due diligence better?
I'm glad you asked, because I just wrote a book about this a couple of weeks ago. I spent like a month writing this book, and I just got it back from our graphic designer. And so I'll be releasing it probably tomorrow. That's a great question. So there are a lot of things to know, and there are administrative things and due diligence and things that you need to understand and be aware of before investing in a syndication with a sponsor. But at the same time, this is, as Andrew says, the most like passive form, like the best thing that you can do to have passive income. Owning apartments, as many of you know, is not passive at all. Most forms of real estate is not. You're going to be dealing with tenant issues and repairs and fixing toilets in the middle of the night and all kinds of crap. Even if you hire a property manager, it's horrible, because you're managing the manager. And I've gotten good at this over the years. I've been through 6 or 7 managers already, but they're going to lie, cheat, and steal from you, and you have to deal with that while you're at work or doing whatever. And so these passive opportunities are really the best thing that's out there and will be the most hands-off. Now, caveat, you have to put in some work up front. You can't just blindly invest in these deals. So I'd say 90% of it comes down to, do you trust the sponsor? Financials and the deal metrics aside, anybody can present something nicely, but if the sponsor is not trustworthy, and it doesn't matter at all. So I think the first thing you want to do is you really want to have a discussion with the sponsor and find out what their strategy is, their level of expertise, and their track record. What deals have they done that have gone full cycle? Why did they work well? What's their edge, their strategy that's going to make them successful? And you want to really just get a good understanding of what they are doing, and if they know what they're talking about. Do they use the industry terms? Do they present things in a conservative way, or are they like, I've seen some sponsors who are just like, I don't actually know. Like, let me do some research and get back to you on that. And I'm like, hold on. Like, I just asked you a simple question. I'm an LP investor too in a bunch of deals. I'm like, I just asked you a simple question, and like, how do you not know the answer? Like, what's your projected exit cap rate on this deal, which is just a fancy way of saying how much are you going to sell the property for at the end? And the guy can't answer the question. It's like, how am I going to trust you to put together a conservative, solid underwriting and then execute on a business plan when you haven't really done this before? I would ensure that the sponsor has done multiple full cycle deals before, that they are able to speak competently and answer all your questions. I think the next most important thing, and this is something that I actually saw Ethan Gao post about, and he's another investor, skin in the game. So if the sponsor is not putting in significant cash themselves, that's a huge red flag. So, and it needs to be, a significant portion of their net worth too. I'd say like maybe like at least 5% of their net worth. Maybe for some people that's too much, but if the sponsor's not putting in $50,000, $100,000, then maybe they don't really believe in the opportunity. But also, you want them to have the most on the line. You want, when the property's not going well, you want the sponsor to be the first person to say, oh shit, like things aren't going well. I'm going to lose my own money. I better do something. Because, you don't, nobody cares as much about your money and your investments as you. And so, you need to make sure that the sponsor like is completely aligned with the incentives. So that's the biggest thing. I'd say another thing that can be a red flag, I would go through the assumptions. So the big trigger points of the deal, like what are they projecting for rent growth? I've seen people projecting 10% year over year for 10 years straight. And it's like, that's unsustainable. That's not conservative. They will not hit their projected IRR, cash on cash, or equity multiple that they're telling investors. I would take a look at the exit cap rate. Are they thinking that they're going to sell the property, at a lower cap rate or higher price, higher income to price ratio than they bought it for? And in conservative underwriting, you always want to assume that the cap rate goes up, that the market is going to be weaker, the sale market is going to be weaker than when they bought it. That's another major lever. Refinance. So if a sponsor thinks they're going to get a refi done at a lower interest rate with great terms in 2 years and cash out the investors 100%, that seems like it's kind of risky. It might not happen. So these are the types of things that you need to like look through and understand. And my book goes through some of these to give you at least a baseline understanding of what you should really know before you get into a deal.
You hit the big two for spot checking underwriting. Because the average LP, they're not going to recreate the underwriting. They're just going to have to look at the key assumptions. There's the third one that I really hold as the triangle of what I'm telling my LP friends. And the third one, and you're going to explain it better, so I'll let you do it, is the operating expense ratio. And I always tell them, it's like, there's no finite answer on this, but there's ranges that make sense depending on the age of the building and the property class of the building. And I'll let you run with it.
I'll make it really simple for the listeners. And agent class aside, I'm just going to do it based on location. If you're in a cold climate with high taxes and a lot of insurance perils, like New York, Vermont, I have a bunch of properties in Vermont, you're going to have a much higher level of expenses in ratio to the income that comes in. So I would expect in those markets to see underwriting of 50%. So you're going to want to see expense to income ratio of 50% in those markets that have high taxes, bad weather, and insurance perils, as opposed to a market like Arizona, where I like to invest, where there's low taxes, great weather year round, so not too much maintenance going on, and a low number of insurance perils. We worry about like fire, and that's it. And so, our expense ratios, I would expect to see in, the 25 to 35% range. And so I would just keep it at those two for a very basic model. If you're in a cold area, that's it's probably a more liberal state, higher taxes, you're going to see closer to 50%. So I would be looking in the 45 to 55% range. And then if you're in warm states that are conservative, I would be looking in the the 25 to 35% range. And then everything else kind of just falls in between. But if you see a deal where they're projecting less than 25% expense ratio, just run.
Yeah, I mean, like one of the things is there was a deal, and we won't name names, of course, but someone had asked a couple of our friends to take a look at a deal, and immediately everyone was going bullshit, because it was a Class C building, it was an older building, and it was in a state with incredibly high property taxes and a state with a lot of insurance bumps. And everyone is saying that there's no way. If this was a Class A, maybe we could stretch it to this. This is a Class C in a Class C neighborhood, and it's old. We're like, come on, who are you kidding? And it was like, that was
it also
to the people. That was it. We're not going to look any further.
That's a good point. And it also depends on the business strategy. I mean, for this, let me ask you, for this deal, were they planning on renovating the building up to a B plus or like an A class status, where there would be no maintenance concerns, and they were going to find a way to lower their insurance premium by half?
It was kind of like a take a C to a B.
Okay.
How quickly, it wasn't like a progression of, by year 3, as we go on, we're going to have a better operating expense. It was just, we'll always be at 35%, and everyone's like, nah, it doesn't work. There's the B's and the B's have a higher operating expense, and you're seeing a C that's older than everybody. Come on now, are you kidding? I mean, like, where did you get these numbers from?
Red flag.
Yeah, I mean, these are the things that if you ask a question in email and it takes 3 days to get an answer back, don't invest with them. If they treat you like you're stupid for asking a question that is stupid, don't work with them. I actually know one investor who purposely comes across like a moron on purpose to see if they're kind. And he does not going to invest with somebody who's rude. And he's kind of kidding, because he's one of the smartest people I've ever met in life. He's playing a game, but he will ask seemingly dumb questions that he knows the answer to, because he wants to see how they respond. And it tells you about their character. It's an interesting test.
Absolutely. No, I couldn't agree more. I've worked with a few investors who have done the same thing. And I think, for a sponsor syndicator who actually understands the deal from, inside out, and the underwriting, and they're extremely confident in the deal, they should be able to answer anything. They should be able to do it quickly. And here's the best part: they should be able to do it in a way that a fifth grader can understand. To be able to, because most people are not so sophisticated that they understand every single input and output and how cash flows work with real estate models. So you have to be able to explain these things to people at a very comprehensible level. You have to, I don't like to use the word dumb it down, but you have to dumb it down a bit and make it simple so that people can understand. And what's great is that these things are simple. There are a lot of moving pieces sometimes, but they're not that complicated. We talk a lot about waterfalls and prefs and splits and stuff. And at the end of the day, it's not that complicated. The investors get their money back. Then they get a certain rate of return. And then after they get that, there's a split. I get some of the money, you get some of the money. And it's not that complicated. And so if you see a sponsor that either doesn't want to answer your question or is not willing to answer your question, I totally agree, Andy. You gotta run.
Yeah. Okay. All right. Two last questions for you. Well, and this one, there's no correct answer because I've heard both sides, both camps on this one, and I won't bias you. I think I think you already know my opinion on the subject, but how do you view the additional revenue streams in the underwriting? Myself personally, I like it as an upside kicker. I do not actually like it in the underwriting myself. I like to be told, this is the base case. We can meet all the hurdles. It pencils. And we're going to do these things. So there's these upside kickers.
Yeah.
Personally, that's what I prefer. My fear when it's built into the underwriting specifically, and you can't easily flush it out like, black and green or red and green or whatever, or yellow, whatever color you want to use. My concern is the bread and butter should be making the underwriting. You shouldn't pet fees, reserve parking, Wi-Fi, Amazon lockers, these things. They're all legitimate. I'm not saying they're not, but if you need all these things to barely make the hurdle, you didn't make the hurdle.
I totally agree. And I think it depends. So I actually had a deal where it was kind of 50-50. We had pet rent in the underwriting because it was already being collected. Okay. Yeah. But also, there was, we were going to add storage units to the property, and we didn't include that in the underwriting. And the reason why is because there's risk involved with setting up new income streams, and there could be a reason why that income stream doesn't come to fruition. So, for example, the city doesn't approve the permit, or the contractor comes back and rebids does the final bid on the project, and it's 3 times the cost. There's a lot of reasons why those income streams never actually make it. And so you wouldn't want to include those. But I think stuff that's already part of the general operations of the property, like, pet rent, and if they're collecting, parking revenue and, late fees and stuff, I would assume some type of forward run rate on those items. Now, there are rare situations where the current owner is not quite capitalizing on something that's so obvious. Like, let's say you're in like a downtown urban area where every single building is charging for parking and you're at 100% occupancy. Well, in that situation, I would feel like very confident, and let's say you don't have a ton of parking in your thing, so there's not an oversupply of it. I would be very confident in assuming that as the leases roll over the next year, you might add $25 a month for, a parking spot or something like that. So it depends. I wouldn't go saying like, hey, I'm going to expect that every time a dog takes a shit, I'm going to be able to collect $500, because I've seen that too. I wouldn't expect everyone to sign up for the Wi-Fi package, or the Alexa home, Ring doorbell bullshit. Like, those are the types of things that are great, and I
love them.
Yeah. I love it.
I love them as upside kickers.
Yeah, and I put out a carousel on LinkedIn with like a whole bunch of different ways to like add value to your property with a whole bunch of creative strategies. But I agree with you that those should not be the reason why the property makes sense. In that case, it's just too thin. The rents are the primary business, collecting rent, leasing apartments, and stuff like charging for club access to a club is great, but I agree with you. The bread and butter, the meat and potatoes needs to be the rent. And if the property doesn't make sense with just rental apartments, it's probably not a great deal.
All right. Now we want to know more about this bomb you dropped on us about this book. What is the book titled?
Sure.
is it going to be on Amazon, and how do people get their hands on this book?
Yeah, sure. It's the multifamily investor's secret, how to earn, yeah, how to earn passive income with minimal effort. So it's exactly what it sounds like. It's historically these opportunities have only been available to the ultra wealthy and the select few, and it's been a secret. But now the secret's out. Everybody has access to these deals, even non-accredited investors, and there are so many people offering opportunities now to get into these deals that you really need to be careful and select them cautiously and understand at least a base level of knowledge about what multifamily is and how these properties operate and what to look out for when you're getting in on these deals. So that's the whole point of the book. It's about 65 pages. It's a really quick read. You can do it in less than an hour. And I highly encourage anyone who's looking to get into these deals to read that. And I also provide a little bit of information on how we structure our deals. And for example, there's a section that goes through the various fees that you could see in one of these deals and what to look out for. And so I provide an example of like the fees that we charge. So that's, yeah.
So how do LPs and GPs both alike get in touch with you if they want to talk more with you and learn about the business?
Super active on LinkedIn right now, so add me. It's linkedin.com/in/Elijah W. Brown, where you can just search my name, Elijah Brown. That's where I'm doing most of my interactions right now, so feel free to add me and follow me and subscribe to the newsletter, and send me a direct message if you want to have a discussion about anything.
Well, Elijah, it's been so much fun having you on the channel, and of course it's been great having you in Hawaii. I'm going to miss having, sending you back to Phoenix, but, I know that you'll be back in Hawaii soon. So then, the next round, we're going to go to brunch, I think. And I think we'll go to the Kahala for brunch. It'll be fun. We can take the families. And just wanted to thank you again. It's really great meeting somebody who's so open about things and intelligent and willing to put all their content out there. And, you're going to think I'm being silly, but I'm really being serious. Most people aren't going to just put it out there like you do and for the world to see and write detailed articles, and I really respect it. I'm really
I've agreed to sell my soul to add value, but
well, you've added a lot of value, so hopefully you got a good amount for that soul.
Thank you, Andrew. That was very, very nice of you, and again, thank you so much for everything that you've done for me and my business over the past month. And, I really value our relationship, and I'm looking forward to our next interaction. So thank you very much.
Thanks, buddy.